Welcome to the Impact COVID-19 legislation on federal employment and payroll taxes, sponsored by the ABA Taxation Section. If you are seeking CLE credit, you must attend the entire program. Partial credit is not available. Please click on all participation verification alerts during the program to confirm your attendance. Immediately after the program ends, a link to complete the certification process will appear. Please complete the evaluation and the CLE affidavit, providing your bar information as requested. Once the completed form is submitted and your attendance verified, your certificate will be emailed to you. Moderating and presenting on your program today is Ed Leyden. Ed is a tax defense and trial attorney at Leyden Law, LLC in Bowie, Maryland. Ed, you may proceed with the program.
Thank you so much. I'd like to, first of all, briefly introduce the rest of today's panel. Joining me today are some very illustrious representatives both from the private sector and the Internal Revenue Service. We have Sidney Gernstein, Kurt Lawson, Lynne Camillo, Will Weissman, Chaya Kundra, Melissa Deuce, and Janine Cook. Briefly, Sid is a branch chief at the IRS Office of Chief Counsel in Washington, D.C. Kurt is a partner and attorney at Hogan, Lovells, U.S. LLP in Washington, D.C., and also before that had an illustrious career of his own in governmental service. Lynne is the chief of the Employment Tax Branch 2 in the IRS, Office of Chief Counsel, also here in Washington, D.C. Will is an attorney at Littler Mendelson PC in Walnut Creek, California. Janine is the Deputy Associate Chief Counsel in tax-exempt and government entities for exempt organizations, employment tax, and governmental entities. Chaya is herself a tax litigator and advisor at Kundra & Associates in Rockville, Maryland, and Melissa is a senior technician reviewer with the IRS Office of Chief Counsel. Her area of focus is employment tax. If you like, you can read their biographies online and learn much more about them. So, having the panelists here, let's move into our first order of business, which is today we're going to focus on three specific areas. We're going to talk about the refundable payroll tax credits and loans that are provided to employees, all of this as a result of recent tax legislation that passed in the past month. We're also going to talk about the payroll tax deferral provisions that were included within that legislation. And finally, we're going to talk about the credit payment process that was established as part of the program in order to provide the most immediate goals, which are pandemic relief and to increase liquidity in the economy by having more money in people and companies' pockets. And with that as background, I will turn the program over to Janine. Janine, would you like to give us a little intro?
Certainly. Thanks, Ed, and good afternoon, everyone. We're glad we're able to do this, even though we can't do it in our normal fashion of all being together. As Ed said, putting those three words together, I'm going to give a quick kickoff to the different provisions we've been working on related to employment taxes and Chief Counsel, and then turn it over first to Sid to start a more detailed walkthrough. I will also note that while we intend to take questions at the end, I do hope folks will understand that with the volume of information that we all are dealing with in processing the new legislation and implementing and getting guidance and information out there as fast as we can, while we have been extraordinarily benefited from the questions we've received, whether it be phone calls, emails, letters, frankly, reading news articles, we are taking all of that in and doing what we can to address different situations. You are welcome to put in your question at the end. We will answer what we can. We will answer where we think we can give clarification based on something that's already been decided and said. We will not speculate on future positions or future items we might put out, and we can't get overly detailed on any one particular fact pattern. So I did just want to kind of manage expectations on what we will be able to do at the end. But again, we are still benefited from your question, even if it ends up that we can't answer it today. So real quickly, again, this office, all of us here in Counsel are from employee benefits exempt organizations and employment taxes. And so with our employment tax expertise, we were given the primary jurisdiction to deal with what are 7 different provisions, 5 of which we will be talking about today. In the Families First Act, you had the 2 paid sick and paid family leave credits in 7001 and 7003. 7002 and 7004 in the Families First Act are actually leave credits in the self-employed context, self-employment equivalent credits. We're not going to be focusing on those today, and it's not certainly the type of things that most who are attending are probably first concerned with. But those are also credits that we will be providing additional information on as we go along, and we have addressed a little bit thus far. And then 7005 in the Families First Act is also a provision that has been wound in, and that was really just kind of dealing with some additional pieces tied to the leave credits about the Social Security tax and Medicare tax components of the leave itself. And then when the CARES Act came along, we got 2 additional provisions that are wrapped in all of this. 2301, which is the employee retention credit. And of course, as some of you may have already seen, we issued many additional frequently asked questions on that last night. And I heard someone joke, if you have 95 some questions, how can any of those be frequently asked? But actually, you might be surprised. Again, going back to all the questions we've received, out of those 90 plus additional questions we released last night, which Sid will walk through somewhat, many of those questions are answering things we heard over and over and over again. So 2301 is the employee retention credit. 2302 is the deferral provision of both deposits and payments, and applies in both in the employment tax and the self-employed context. And Lynne will be addressing some of that. And then I also want to note that the CARES Act actually made an amendment to the leave credit provisions of the Families First Act, and that was to confirm the ability to do advances, which is a unique process which we have implemented, and Missy in large part will walk through a little bit of that. So those are the provisions that we've been working at length on. Of course, there are other things within both of those pieces of legislation that might touch on our jurisdiction or where we might give assistance to other offices, but it's not the focus of today. Ed did mention the Payroll Protection Program loan, which was also obviously a key feature of the CARES Act. And also just to note there, we do not own that program, as you might imagine. That's a Small Business Administration program. I believe the Treasury Department provides assistance in interpreting and applying those rules. And we've certainly been engaged in some, to the effect that there's an interaction there between the loan, the Payroll Protection Program loan, and the employee retention credit. There's also an interaction between, in these sections, about when that loan is, if that loan is eventually forgiven, how does that apply to deferrals? So the team will be addressing that in the next hour here. But again, to manage expectations, I do want people to understand that we do not manage or interpret the loan programs. And so to the extent there are questions on those, again, you're happy to voice them, and we can take them back or share them. But we will likely not be able to answer them unless it's specific as to something we have already said with regard to the interaction. And then finally, I will just note that in this entire process, obviously there's a lot of coordination, not only within all of Counsel in our office in interpreting the law and making decisions about what legally this provision means, that provision means, but of course working closely with our Treasury colleagues in those implementation questions, in the policy questions, and in then, of course, providing information to taxpayers and tax practitioners about how these credits work. And then, of course, we are equally spending a lot of time working with the IRS to set it all up and to create the process, the forms, answer legal questions that they need to know for their system and form purposes. And so it's kind of a multifaceted approach, similar to what many of you are probably doing with your clients and helping them understand the law and then also helping them understand how to proceed. So with that introduction, again, I thank you for having us, and I turn it to Sid for walking through the credits.
All right. Thank you so much, Janine, and thank you, everyone, for having us. So I'm going to walk through the credits. As Janine said, there are 3 new credits available for employers under the Families First Act and under the CARES Act. So 2 of those credits for employers are under the Families First Act. These credits reimburse employers for providing employees with paid sick leave and paid family leave for reasons relating to the coronavirus. Then there's 1 credit under the CARES Act. That's the Employee Retention Credit. That reimburses employers for continuing to pay their workers despite economic hardships related to COVID-19. Now, as Janine mentioned, yesterday, the IRS issued a new and very extensive set of FAQs on the Employee Retention Credit. You can find this at irs.gov. And actually, if you just go to the link where the old set of FAQs was, it'll repopulate with those new FAQs. And then also I'm going to discuss those, some of the substance of those FAQs when I get to the Employee Retention Credit in a few minutes. So just as a general overview, all of these credits are subject to various limitations and nuances that I'll go through, but both generally operate in the same way. They're fully refundable tax credits against the employer's share of Social Security taxes. There's an option for employers to request in advance for their credits if they do not have sufficient employment tax withholdings. As Janine mentioned, but we're not going to get too much into right now, the Families First Act also provides similar credits for self-employed individuals for sick and family leave. So now I'm going to walk through the credits in a bit more detailed. So first, covering the paid leave credits under the Families First Act. As I said, there's a credit for providing paid sick leave and a credit for providing paid family leave. These credits basically operate by piggybacking off DOL provisions in the Families First Act. So like the Families First Act requires employers to provide employees with paid sick leave and paid family leave. And the requirements for the employers to provide the paid sick leave are found in Division E of the Families First Act. That's the Emergency Paid Sick Leave Act. The requirements for employers to provide employees with the paid family leave are found in Division C of the Families First Act, and that's the Emergency Family and Medical Leave Expansion Act. Now, it's important to remember that DOL has jurisdiction over those 2 provisions, over Division C and E. The tax credits are found in Division G of the Families First Act, Sections 7001 to 7005, and these tax credit provisions are designed really to be like congruent and proportional to those leave requirements, so that ultimately the government is reimbursing employers for providing the cost of providing that required leave under those DOL provisions. So it's important to keep this in structure in mind, because to the extent that the issue is, well, whether and to what extent an employer must provide paid leave, that's really an issue for the DOL. It's Division C and E are their provisions. We would defer to them to interpret them. But to the extent that the issue is whether and to what extent an employer may claim a tax credit for providing the paid leave, that's an issue for us. These credits under the FFCRA apply to wages paid for the period of April 1, 2020 through December 31st, 2020. Basically, all private employers with fewer than 500 employees are eligible for the credits. So there are some exceptions. Perhaps the most notable exception from the eligibility for the tax credits is governmental employers, including agencies and instrumentalities of federal, state, and local governments. But these entities are required to provide the leave under the DOL rules. So they are required to provide the leave, but they can't get tax credits for providing that leave. There are also potential opt-out provisions under the DOL provisions from the requirements to provide paid leave for employers of healthcare providers and emergency responders. And then there's also a potential opt-out for employers with under 50 employees for whom the requirements would jeopardize the viability of the business as a going concern. And of course, if an employer opts out of providing the paid leave under one of those DOL provisions, there would be no paid leave for which they could claim the tax credit, so they couldn't get the credit. The credits that the employers receive, the amount of them under 7001 and 7003 are increased under 7005 by the employer's share of Medicare tax imposed on the qualified leave wages. They're also increased under 7001 and 7003 by the qualified health expenses that are allocable to the qualified leave wages. The qualified leave wages are not subject to the employer's share of Social Security tax. So just taking a step back, basically employers don't have FICA liability for their share of FICA because the wages are not subject to the employer's share of Social Security tax, and then they get the credit or an amount of credit for the employer's share of Medicare tax. Qualified leave wages for both family leave and the qualified sick leave wages, they're defined as wages under Section 3121A of the Code that employers are required to pay under the Families First Act. So that is their FICA wages, the FICA wages that employers are required to pay under that Emergency Paid Sick Leave Act and the Emergency Family and Medical Leave Expansion Act. So a little bit more about that credit that employers may receive for providing paid sick leave under the Families First Act. This sick leave credit piggybacks off the requirement to provide paid sick leave under the Emergency Paid Sick Leave Act. So it's available when an employer pays an employee qualified sick leave wages because of one of 6 reasons. And I'm going to break down these 6 reasons into 2 groups of 3 reasons. And that's important, and you'll see for a second. The first group of 3 covers reasons that an employee is unable to work or telework due to their own personal health condition. So that is, the employee is unable to work or telework because he or she is subject to a federal, state, or local quarantine or isolation order related to COVID-19. The individual has been advised by a healthcare provider to self-quarantine due to concerns related to COVID-19, or the individual has COVID-19 symptoms and is seeking a medical diagnosis. So again, the employee is unable to work or telework because of their own personal health condition. Now, the next group of 3 reasons covers reasons that an employee is unable to work or telework because he or she has to care for someone else. So that is like the employee is unable to work or telework because he or she is caring for an individual who is subject to a quarantine or isolation order or advice. The individual is caring for a child because the child's school or place of care is closed, or the worker is caring for a child because the child's paid child care provider is unavailable due to COVID-19. The employer may claim this credit for up to 80 hours of leave it provides. The amount of the credit depends on the reason for which the employee was unable to work or telework. If the if this fell under that first category I mentioned, if the employee is unable to work or telework because of the employee's own health condition, the credit is based on the employee's regular rate of pay up to $511 per day, but no more than $5,110 in total. If, by contrast, the employee is unable to work or telework because the employee has to care for someone else, that's that second category of 3 reasons, the credit is based on 2/3 of the employee's regular rate of pay, up to $200 per day, but no more than $2,000 in total. As I mentioned, there are those 2 notable exceptions to this requirement, that employers with fewer than 500 employees provide the sick leave, for employers of certain healthcare providers or emergency responders, and for those employers with fewer than 50 employees, if it would jeopardize the viability of the business. But that fewer than 50 employees exception, again, it's under the DOL rules, but just note that it only those employers can only opt out of the requirement to provide paid sick leave to an employee who is unable to work or telework for the reason that the employee is caring for a child because the child's school or place of care is closed, or is caring for a child because the child's paid child care provider is unavailable due to COVID-19. Again, there's a equivalent credit for self-employed individuals. So that's the sick leave credit. Now, about the tax credit for an employer that an employer may receive for providing paid family and medical leave under the Families First Act. This piggybacks off of the requirement to provide paid family leave under the Emergency Family and Medical Leave expansion. Note, as the name suggests, this DOL provision expands the Family and Medical Leave Act to cover certain COVID-19 circumstances. Unlike, though, the FMLA, which generally applies to employers with 50 or more employees, this expanded FMLA applies to employers with fewer than 500 employees. So it covers like more small employers than the rest of the FMLA does, but doesn't cover as many larger ones as the rest of the FMLA. This credit reimburses an employer for providing an employee with paid leave because the employee is unable to work or telework, because he or she is caring for a child, because the child's school or place of care is closed, or he or she is caring for a child because the child's paid child care provider is unavailable due to COVID-19. So there's some overlap there with a couple of the sick leave criteria that I discussed earlier. Now, this credit, though, for paid family and medical leave is available for up to 10 weeks of paid family leave that the employer provides under the Families First Act. Now, it's worth noting that under the DOL rules, the Emergency Family and Medical Leave expansion actually requires employers to provide up to 12 weeks of leave, the reasons related to COVID-19 that I just described, but the first 2 weeks of those 12 can be unpaid under the DOL rules. It's only the next 10 that must be paid, and because it's only those weeks for which the employer must actually pay leave, it's only those weeks for which the employer gets the credits. So that's 2 weeks for sick, 10 for family at maximum levels. The wages for which the employer can receive this family leave credit is limited to up to 2/3 of the employee's regular rate of pay, up to $200 per day, but not more than $10,000 in total. The requirements to provide paid family leave are basically subject to the same exceptions as those that apply to the paid sick leave for emergency responders. There's an opt-out for employers with fewer than 50 employees. So basically those same ones apply here. So those are the two credits under the Families First Act. And now I'm going to move into the employee retention credit under the CARES Act that came along later. What this credit basically does is it reimburses employers for continuing to pay their employees despite economic hardship related to COVID-19. Like the Families First Act credits, fully refundable, but this one, the employee retention credit is equal to 50% of up to $10,000 in qualified wages. It applies to wages paid after March 12, 2020 and before January 1st, 2021. Self-employed individuals may not claim this credit or a comparable one. Employers eligible for the credit must carry on a trade or business. Now note that 501c3s are deemed to be engaged in a trade or business with respect to all their operations for purposes of this credit. Federal, state, and local governments and their instrumentalities may not claim the credit. An eligible employer for purposes of the employee retention credit includes all members of an aggregated group that are treated as a single employer. This is under 2301D of the CARES Act and the employee retention credit provisions. Now, all entities are treated as a single employer under Section 52A or 52B, or under Sections 414M or O of the Code. All those are considered as one employer for the purposes of the employee retention credit. Employers generally may claim the employee retention credit for wages they pay employees despite the existence of either of two conditions. First condition is that the employer's operations have been suspended or partially suspended due to governmental orders due to COVID-19, or the employer's business is experiencing a significant decline in gross receipts compared to 2019. Just bear with me, but what you have to get out, there's some nuances to each of those tests, but particularly here with that significant decline in gross receipts, this significant decline in gross receipts begins with the first quarter in which an employer's gross receipts for a calendar quarter in 2020 are less than 50% of its gross receipts for that same calendar quarter in 2019. This significant decline in gross receipts ends with the first calendar quarter that follows the first calendar quarter for which the employer's 2020 gross receipts for the quarter are greater than 80% of its gross receipts for the same calendar quarter during 2019. So basically that once they reach that 80% threshold, the credit turns off the next quarter. There's a nuance in these rules that distinguish the wages for which employers with 100 or fewer employees may claim the credit from those wages for which employers with more than 100 employees may claim the credit. Employers with 100 or fewer employees may claim the credit for any wages that they pay to employees during one of the periods I described above. However, employers with more than 100 full-time employees may claim the credit only for those wages paid to employees for periods during which the employees are not providing services. Further, for this category of larger employers, these qualified wages may not exceed what the employee would have been paid for working an equivalent duration during the 30 days immediately preceding the period of the economic hardship. So what this basically means is that these large employers, they can't give their employees a sudden raise and get the credit for that raise. Now I'm going to discuss a little bit more about the conditions under which a government order suspends or partially suspends an employer's operations. We cover these in a good amount of detail in that new set of FAQs that just went live, so I encourage you to read that for more information, but there were a lot of questions about this and a lot of deliberation about this. So government orders that may entitle an employer to the employee retention credit include orders, proclamations, or decrees from the federal government or any state or local government. They are considered orders from an appropriate governmental authority if they limit commerce, travel, or group meetings due to COVID-19 in a manner that affects an employer's operation of its trade or business, including orders that limit hours of operation, and the orders are from a state or local government. They're from a state or local government that has jurisdiction over the employer's operations. This criteria applies only for periods during the calendar quarters in which the trade or business operations were fully or partially suspended. So if the order was effective only for a portion of the calendar quarter, even though the employer is considered an eligible employer for the entire calendar quarter, it can only claim a credit for wages paid during the period that the order is in force. So one issue that's come up and that we addressed in the FAQs is how this applies to businesses that are deemed essential. An employer that operates an essential business is not considered to have a full or partial suspension of operations if the governmental order allows the employer to remain open, even though the governmental order requiring non-essential businesses to close may have some effect on that essential employer's operations. However, an employer with an essential business may be considered to have a full or partial suspension of operations if the business's suppliers are unable to make deliveries of critical goods or materials due to a governmental order that causes the supplier to suspend its operations. Now, the fact that employers must telework does not alone deem the business fully or partially suspended. However, if an employer's workforce is closed by a government order for certain purposes, but the workforce may remain open for other purposes, or the employer is able to continue certain operations remotely, the employer's operations could be considered to be partially suspended. So one example to make this a little bit more concrete would be a restaurant that can only provide carryout or delivery now, but can't have in-establishment dining. That could potentially be a partial shutdown for purposes of the employee retention credit. In addition, employers that operate a trade or business in multiple locations and are subject to state and local governmental orders limiting operations in some, but not all, jurisdictions are considered to have a partial suspension of operations. Now turning back a little bit more to discuss some more about the conditions under which an employer experiences a significant decline in gross receipts, which was the other possible condition entitling an employer to this credit. The base period for determining the gross receipts test is, as I mentioned, the corresponding quarter in 2019. Those new FAQs that I mentioned that we just released describe how an employer that started a business in 2019 and thus does not have four full quarters of 2019 gross receipts with which to compare its 2019 gross receipts, how an employer in those circumstances would determine that it had a significant decline in gross receipts for the purposes of this credit. The new FAQs also describe how an employer that acquires a trade or business during the 2020 calendar year can determine if it had a significant decline in gross receipts. So again, encourage you to go. There's 95 FAQs there. We cover a lot of material and have a lot of examples and address a lot of questions. As Janine said, it's hard to imagine that we got 95 questions that many times, but a lot of them we did keep cropping up routinely. A few additional thoughts about the employee retention credit. The wages taken into account for the retention credit are reduced by any wages for which the employer received those Families First Act leave credits. The wages, unlike the Families First Act ones, they are subject to the employer's share of Social Security, and there's no credit for the employer's share of Medicare tax. Like the Families First Act credits, allocable qualified health expenses are added to the credit. An employer who gets the retention credit cannot get one of the PPP loans that we mentioned at the top that the SBA is providing small businesses to cover payroll costs. An employer may not claim the retention credit for any wages paid to an individual for whom the employer receives a work opportunity tax credit under Section 51. Tax-exempt entities may claim the credit. Government employers may not claim this credit. And similar to the Families First Act, wages for which an employer may claim the employee retention credit are defined as FICA wages under 3121A. I'm sorry, I think I may have just misspoke. I went a little too quickly. If you get a PPP loan, you cannot get the employee retention credit. I just want to make that clear. I may have gone a little too quickly through that one. But yeah, if you get that PPP loan, you can't get the employee retention credit. We also received some questions concerning whether employers can claim the employee retention credit for paid time off or for severance payments. The FAQs that we released specify that if the eligible employer averaged more than 100 full-time employees in 2019, the employer may not treat as qualified wages amounts paid to employees for paid time off for vacations, holidays, sick days, and other days off. These are not considered to be for time in which the employee is not providing services. However, if the eligible employer averaged 100 or fewer full-time employees in 2019, all wages paid to employees during the period of the full or partial suspension of operations or the significant decline in gross receipts, even if under a pre-existing vacation, sick, or other leave policy, may be qualified wages for purposes of the employee retention credit. The FAQs also specify that payments, including severance payments, made to a former employee following termination of the employment are not considered qualified wages for purposes of the employee retention credit. These are payments for past employment relationship and thus are not attributable to the time for which the employee retention credit may be claimed. The FAQs also specify the situation in which an employer only pays its employees' health plan expenses. So if the eligible employer lays off or furloughs its employees, but continues to pay for the employee's health care coverage, but is not paying the employees any wages for the time they are not working, the employer may not treat any portion of the health plan expenses as qualified wages for purposes of the employee retention credit, because no portion of the health plan expenses would be eligible to wages paid to the employees. So just briefly, these credits are against the employer's share of Social Security tax, and the excess goes against the employer's entire employment tax liability and then it's refunded. If the employer doesn't have sufficient employment taxes set aside to cover the leave, It can request in advance from the IRS in the Form 7200, advance payment of employer credits due to COVID-19, which I think Missy is going to talk about later. The employer can reduce its employment taxes to cover the credit without incurring a failure to deposit penalty. That's if the eligible employer paid qualified wages to its employees in the calendar quarter before the required deposit. If the total amount of federal employment taxes that the eligible employer does not timely deposit, then reduced by any amount of the employer's share of Social Security tax deferred under 2302 of the CARES Act that Lynne's going to talk about in a moment, and any amount of federal employment taxes not deposited in anticipation of the credits claimed for paid sick and or family leave under the Families First Act. If those deposits are less than or equal to the amount of the eligible employer's anticipated employee retention credit for the qualified wages for the calendar quarter as of the time of the required deposit, and if the eligible employer did not seek payment of an advance credit by filing that 7200, the employer will not be subject to the penalty for failing to deposit. So now I think Kurt, I realized that was a lot of material. Again, apologize for going through so quickly. I wanted to cover that. See our FAQs for more. And now I think Kurt has some other discussion on this topic that he wanted to provide.
Sure. Thanks, Sid. That's a really wonderful description, quick as it was, of the provisions in the statute and some of the nuances of the FAQs that were just released. Just to, I'm going to break down my part between the two acts, talking first about some issues under FFCRA that weren't addressed or weren't addressed completely in the FAQs, and then the CARES Act, if you don't mind. Just to highlight some of the differences, the specific provisions of the FFCRA, things I would note is that there is an addition to the amount of the credit for the Medicare tax, the employer portion of the Medicare tax, which you don't have in the retention tax area. There's an exemption from at least the employer portion of Social Security taxes for the leave itself, which you don't also don't see in the retention credit. You also have the fact that the credits under the FFCRA are taxable and therefore associated payroll payments, the leave payments themselves, and employer taxes on those are deductible. You also have differences in the eligible employers, as Sid mentioned. Governmental employers and self-employed can get the credits under the FFCRA, but not the retention credit. And I guess last to highlight on this first part, the FFCRA, if you take a FFCRA credit, you aren't disqualified from doing that if you are seeking a PPP forgivable loan, unlike the retention credit where that's a disqualifying feature. Among the things I thought were still left open under the FFCRA would be some of the 6652 issues and substantiation issues. Let me just get into that. Notice 2020-22, which you didn't mention, was a previous bit of guidance. Says that employers are relieved from those taxes if they do not make payroll tax deposits in anticipation of receiving actually either the FFCRA or the retention credit. I noticed that in that notice, the forgiveness extends to wages and leave that are paid in the previous quarter. But I'm not sure that I'm reading that right, and I guess I just wanted some confirmation that even if the deposits are being made during a quarter with respect to wages and leave that are paid during the quarter, that the penalty relief would apply. I think I'm just reading that notice a bit too literally. Did you have a reaction to that, Sid?
Kurt, this is Janine. I'll jump in. I think Lynn was going to cover a little bit more of the deferral and deposit reduction issues coming up.
Yeah.
But I guess if you could just also restate, what was the language you thought in the notice wasn't clear to you on the deposit reductions?
Yeah. Of course. The notice says, in describing the relief that is provided, it says that the relief is with respect to wages, and I think that would include leave based on under the FFCRA that were paid in the previous quarter. And I just wanted confirmation that is not the extent of the forgiveness under the failure to deposit rule, that it extends to deposits with respect to wages and leave during the quarter itself.
Yes, I think that's right, if we're understanding your question, but I think Lynn is going to go over the notice a little bit at the end, so maybe talking through it then will also help clarify each piece as it stacks together. Okay.
Very good. I noticed that the FFCRA Qs and As contain pretty extensive substantiation requirements. They've been there for a while. I didn't see anything similar in the retention credit FAQs, but either you might correct me and say there is some there. If there isn't, I was wondering whether the overall approach of the substantiation requirements under the FFCRA, which are pretty demanding in terms of the kinds of the precision with which employers are supposed to keep their records, would be a good guide under the retention credit as well. Things like the calculation of the exact amount that the credit is based on, things like that. And the reasons for the employer being closed or justifying a credit based on the reduction in the gross proceeds, gross revenues.
All right, thanks. Yeah, as you noticed, we don't cover the substantiation and the retention credit, including in that second tranche that we just released. We don't cover substantiation in as thorough detail and we don't break it down as much as we did for the FFCRA. Generally, I think it's safe to say that the employer should be using like any reasonable methods and taking reasonable measures. That probably using the FFCRA as a general bar, as just speaking personally, because in the absence of specific advice from us, that doesn't seem like a bad way to go and a bad guide. But we have not yet addressed like the specific substantiation requirements in as much detail as we were able to for the FFCRA.
Great. Thanks a lot. I appreciate the guidance. I think that it might be new in the FFCRA Qs and As talking about how leave is going to be treated for various other purposes, including, for example, the ability to make 401k contributions out of that leave. And I just want to really just point the listeners to some of that additional guidance. The one thing I did want to ask about in terms of how those leave payments were treated for tax purposes was apparent conflict between the FAQs and the Blue Book. The Blue Book seems to say, actually it says specifically that the exclusion extends to both the employer and the employee portion of Social Security taxes, but the statute literally, and I think the FAQs limit that to the employer portion. And I guess I wanted to highlight that conflict and ask whether that was in fact your understanding.
Our understanding is that the exclusion applies only to that employer's share of Social Security.
Yeah. Okay. And lastly, in pointing the listeners to some additional guidance, I noticed that there's a specific statement in the FFCRA Qs and As, which is also in the retention credit Qs and As, that Section 139, which is the exclusion for disaster type benefits that an employee might receive, does not apply to the sick leave and family leave under that act. I thought it was interesting. I didn't know whether there was anything in the statute about that, but it seemed like an appropriate interpretation based solely on the statute. And no.
Okay, so you're just pointing out that the position was that 139 yet does not apply. These are income replacements, not like lump sum payments to cover certain expenses.
Right. Yeah. And as I said, I just wanted to draw attention to the listeners to that provision. And once again, to reiterate what you mentioned before, that there's a lot of guidance in the FAQs, particularly the ones that were issued just yesterday and last night, and employers that have lingering questions should go there first. Okay. Retention credit, same kind of situation, just a few questions and an amplification of some remarks that you made. Overall, one thing to point out, I think, is that the potential benefits of the retention credit, at least to my mind, are significantly higher, greater financially than the credits available under the FFCRA. They're still limited, but they are somewhat more substantial. As I indicated before, there are significant differences between the two. For example, governmental employers and self-employed can't take advantage of the retention credit. There's no exclusion from Social Security taxes, no additional Medicare tax credit that is available. But another, in terms of employers' approaches to these things, that's worth highlighting again, is that you're completely disqualified from receiving this credit if you have a PPP loan. And the FAQs make it clear that that could be a PPP loan anywhere in the control group using the aggregation rules in the FAQs and the statute. And I guess at any time, it doesn't, even if it's for a different period, that can be true. I've had the question whether you're disqualified if you've merely applied for a PPP loan but not received it. I'm not sure that is a relevant situation, given that the PPP loan funds are dried up to a significant extent, and it might be an issue for the future. So I wondered whether you had any comments on that. If you've applied for a loan but you haven't gotten it, there can be a delay, certainly. Is that enough to disqualify you from taking the credit? Say your deposits are due or your 941 is due, or do you wait until you've actually been approved for a loan?
Those are some issues that, again, like the loan issues, as we've mentioned, are more for SBA. But quickly, I just wanted to take a step back and just clarify that government, the FFCRA loan or the FFCRA credits, government employers cannot get the credit. They have to provide the leave, but they can't get that credit in the same way they can't get the retention credit. As far as the issues with respect to the interaction between the retention credit and the PPP loan, as we said, and as you noted, Kurt, the general rule is that if you get that PPP loan, you can't get that. You can't get the retention credit. But as the nuances of the temporal aspects and those issues, we're still working through that and still working with Treasury and different the SBA and exactly how those rules play out.
Great, thank you very much. And sorry, I did misspeak on the governmental eligibility for the credit itself as opposed to the leave. Shifting to the FAQs, there is a lot of additional detail in there on questions I've heard frequently. In the first bunch, there are there's additional guidance on eligibility rules, including, as you pointed out, some supply chain issues which come up quite frequently, and it does appear that there is some ability for employers who are affected by shutdowns of their critical suppliers to take advantage of that based on the governmental shutdown prong. But by and large, when employees, or excuse me, when customers are merely not showing up because of their own shutdown issues or shutdown issues, that's not going to be enough. One thing that has starting to come up as we hopefully move out of the shutdown phase of handling COVID-19 is at what point will the eligibility for the credit cease? Their governmental orders in various states are opening up businesses piecemeal, but there will be a period of time when there's still some lingering effects of the governmental shutdowns. Is it the case that as soon as the governmental shutdown orders cease to apply to an entity, taking into account all the FAQ additional guidance, that would be enough to disqualify it from further amounts, or would it be further credits, or would it somehow be phased in?
First of all, the credit cuts off, of course, January 1, 2021, so it's got to be before then. With respect to a specific order, wanted to clarify, remember, the credit, you're an eligible employer for the calendar quarter during which you're subject to that government order, but you can only claim the credit for wages that are paid during the period of the order. So if there's no order, you can't claim the credit for wages during that time.
Right. So at least pending any further guidance, which of course we couldn't count on, once the order is no longer applies to the business, then eligibility will cease.
That generally, yes. Now, of course, remember that the gross receipts test is still there. So if the employer's, and just before that, I do want to clarify also, there's a good possibility that we may be releasing future tranches of FAQs. So you may not have heard the last from us on this.
Okay, glad to hear that. I was going to ask that as a general matter. There's some helpful guidance on tax exempts, clarifying that their ability to rely on either prong of the eligibility test, which wasn't entirely clear from the statute. I think there was a bit of an issue whether the tax exempt had to have an unrelated trade or business in order to qualify, but that's clearly not the case, and the FAQs make that quite clear. The FAQs do say that we can anticipate future guidance on how the gross receipts prong of the test applies to them. Is that something you're actively working on, and we might see a guidance soon?
I can't speak to any specific guidance. I can say we're continuing to receive questions, field questions, and discuss other issues. I can't say anything about any concrete specific timeline for any specific guidance.
Okay, great. I understand that. The governmental order prong applies to trades or businesses. One question that's come up is whether you have to basically split a business up into separate trades or businesses and apply the shutdown order separately to each, or is kind of like a tax exempt, is the entire company and its affiliates treated as a single trade or business?
I think one thing to take a step back and recognize is those aggregation rules are important. Mm-hmm. And it's really the aggregation rule that determines whether the separate related entities are going to be subject. So if as the FAQs specify under those 52 and 414 rule, well, it's really the 52 rules for the credit. Under those 52 rules, if they're related entities and one of them is subject to the government order, then they are considered to have be subject to the government order and to this partial suspension.
Okay, great, thanks. I had just two more questions. Hopefully we can finish that and move on to the other important topics. One is, there seems to be, again, a slight difference in view between the Blue Book and the FAQs on how you count the 100 employees for purposes of the threshold on what wages are creditable. The Blue Book seems to say you take into account full-time equivalent employees, so it's sort of a portion of part-time employees, but Q&A 49 in the FAQs seems to say no, you just count the full-time employees. Am I reading that correctly?
What we said in the FAQs, that would be our position. That'd be our reading.
Okay. Perhaps the other speakers can correct me if my reading of that is wrong, but I thought that was the outcome. As I think you mentioned, there's some limits on what kinds of pay are going to count. Vacation pay and paid time off doesn't necessarily count. You also mentioned that healthcare coverage could be included in qualified wages for which a credit was allowed only if other cash wages were paid, which is a question that has come up frequently. There's also the possibility, though, of paying individuals on leave a reduced amount. So I take it there wouldn't be a particular problem if you paid individuals on paid leave a reduced amount, maybe even a very small amount, and also continue to pay them, provide them with health insurance. You could still, in other words, get. Please go ahead.
Yeah, as a general matter, yes. Again, I urge everyone to look at the FAQs for that, and we have a couple of examples that actually provide some numbers that can kind of show the reduced wages and situations under which there could be reduced wages, but full healthcare costs and the full healthcare costs are still credible.
Right. Thanks. There's also quite a bit of guidance, helpful guidance on how to determine when an employee or the extent to which an employee is not at work, or I should say when for employers that have over 100 employees, they are being paid. They're paying employees for time spent not at work. And it effectively focuses on the hours and days of service that an individual is working. The questions that I see come up mostly relate to exempt employees who aren't keeping track of their hours. Their employers aren't necessarily keeping track of their hours. There is a statement that you can't take an employee's decreased productivity levels, for example, if they're working from home and just aren't able to put in the hours because of other distractions that they otherwise would, or not doing as much as they otherwise would. So that is addressed specifically in the Q's and A's. But there are other situations where an individual might be able to be, the degree to which the individual was not working might be able to be measured better. For example, a salesman who typically makes rounds of his customers for a week out of the month or something, but can't do that. Nevertheless, gets paid in some fashion for that. Or employees who really need access to the workplace to do a portion of their job but not all of their job. I guess I wonder the extent to which we can count, if we manage to count hours and compare that to previous average hours performed by these professional and other exempt employees, is that going to be acceptable, and what level of proof maybe in those situations would you be looking for?
Well, thank you so much for the comment and for providing those fact scenarios. One thing that's amazed us is, or at least amazed me, is the number of different scenarios that we're learning about by virtue of this guidance. I can't speak, as Janine mentioned at the very top, I can't speak to specific hypotheticals that are not covered in the FAQs, but there may be more FAQs that come out, but just as a general principle, if it's just merely reduced productivity, that's one line. It's just reduced productivity. It's not that's not services for those larger employers. So to the extent that something's kind of be like a facts and circumstances, I think, to the extent something's quantifiable that seems relevant, but I can't speak to black and white with any conclusions with respect to any of the myriad of hypotheticals, and especially because for one employer they may be able to track the hours, but in an identical situation there just may not be the capability to track that. So there's just a whole host of a lot of gray with this area. But thank you for raising that. It helps us to hear these, and we can continue to fine-tune these rules and fine-tune our analysis. Okay, great. Thanks a lot. We, of course, are not focusing on PPP loans, and I'm not going to spend really any time on that. I did want to raise one question in case you have thoughts. The PPP loan forgiveness is, of course, not taxable, and the questions come up whether in the tax realm that means that related wages that are required to be paid in order to earn the forgiveness are not deductible under kind of general principles of under the Internal Revenue Code. I don't think there's guidance published to date, and I just wanted to pose that question in case you have a thought. I don't think we've specifically addressed that yet, but thank you for raising that. Okay. Then I'm going to turn it over to the next presenter.
Okay. Thank you. Hi, this is Lynne Camillo. Section 2302 of the CARES Act allows employers to defer the deposit and payment of the employer's share of Social Security taxes. And for employers covered under the Railroad Retirement Tax Act, the deferral applies to the equivalent employer taxes imposed under Section 3221A of the Internal Revenue Code. The deferral applies to deposits and payments of the employer's share of Social Security tax that would otherwise be required to be made during the period beginning on March 27th, 2020, and ending on December 31, 2020. This is called the Payroll Tax Deferral period. Employers that choose to defer deposit and payment of the employer's share of Social Security tax must deposit 50% of the amount deferred by December 31, 2021, and the remaining 50% by December 31, 2022, in order to avoid failure to deposit and failure to pay penalties. The ability to defer applies to all employers with one exception. Employers that receive a loan under the Paycheck Protection Program may not defer the deposit and payment of the employer's share of Social Security tax due on or after the date that their Paycheck Protection Program loan is forgiven. This means that employers can no longer defer deposit and payment of the employer's share of Social Security tax that is otherwise due after they receive a decision from their lender that their loan has been forgiven. An employer that has applied for loan forgiveness of their Paycheck Protection Program loan can continue to defer deposit and payment of the employer's share of Social Security tax up until the date that they receive notification that their loan has been forgiven. I think it was already mentioned that Notice 2020-22 provided relief from the failure to deposit penalty for not making deposits of employment taxes, including taxes withheld from employees, in anticipation of the leave credits and the employee retention credits. The ability to defer deposits of the employer's share of Social Security tax under Section 2302 of the CARES Act is in addition to the relief provided in Notice 2020-22. Employers that are eligible to claim leave credits under the Families First Coronavirus Relief Act or the Employee Retention Credit under the CARES Act can defer deposit of the employer portion of Social Security tax during the deferral period before determining the amount of employment tax deposits that they can retain in anticipation of these credits, the amount of any advance payments of the credits, or the amount of any refunds with respect to these credits. There is no special election required to be able to defer deposits and payments of these employment taxes. The Form 941 will be revised for the second calendar quarter of 2020 to accommodate this deferral. For employers that use designated agents under Section 3504 of the Internal Revenue Code or enter into service contracts with certified professional employer organizations, CPEOs, and that direct their agent or CPEO to defer payment of the employer's Social Security tax. The CARES Act provides that the employer will be solely liable for the payment of those taxes by the applicable date. The CARES Act has a similar provision that allows self-employed individuals to defer payment of 50% of Social Security tax imposed on net earnings from self-employment during the payroll tax deferral period. This is the same payroll tax deferral period that applies for employers, the period beginning on March 27, 2020 and ending on December 31, 2020. And for those self-employed individuals who choose to defer, 50% of the amount deferred must be paid by December 31, 2021, and the remaining 50% must be paid by December 31, 2022. There's a set of frequently asked questions on these deferral provisions posted on irs.gov. We'll continue to update these to address additional questions as they arise. So please do keep checking those to get the latest information. And I will turn it over now to Will, who I think has some comments or questions.
Yeah, just to, so we can keep moving along. I know there's a lot of people that would like to ask the IRS some questions. The IRS had posted some notices a while back, deferring, and I'll use that term sort of broadly, filing requirements. And Lynn, can you just sort of clarify what kind of returns can be pushed out? It was to July 15th, and what kind of returns cannot?
Yeah, thanks, Will. The IRS has extended the date for filing 2019 income tax returns until July 15th, 2020. Income tax returns for 2019, of course, would normally be due to be filed on April 15th, 2020. I would refer everyone to the Notice 2020-23 for the latest information on IRS extensions for time-sensitive acts. I won't go through all the extended dates in that notice. There's a whole host of dates and actions that have been extended, including the date by which to file refund claims, the date by which tax court petitions and refund suits need to be filed, and the date by which certain estate and trust income tax payments can be made. I will note, though, there has been no extension of the date to file employment tax returns. So the July 15th date doesn't have relevance for employment tax returns. The first quarter employment tax return is still due to be filed on April 30th today. And the second quarter is due to be filed on July 31st.
Great. Thanks, Lynn. And just one other question then, and we'll move it along. The tax deferral doesn't apply after a PPP loan is forgiven. But what happens if there's either a dispute or it's not forgiven, or perhaps only a portion of the loan is forgiven? What happens with the deferral then?
Well, I'll note that the IRS does not manage or interpret the loan forgiveness provisions, so there's not really anything I can say about that. But the statute about the deferral of the employer's share of Social Security taxes says that the deferral does not apply if a taxpayer has had indebtedness forgiven under Section 1106 or 1109 of the CARES Act. And the statutory language does not quantify whether this means partial forgiveness or complete forgiveness. And the IRS has not come out with anything official on partial loan forgiveness. Thanks for raising this, though. We're happy to consider whether further clarity on that is needed. And as I think I mentioned, we'll be updating the frequently asked questions periodically to address additional questions as they arise. That's an ongoing process. So do keep checking on irs.gov for new information.
Great, thanks, Lynn. And I know we have more topics to cover, so we'll keep moving it along.
Okay, at this point, I'll turn it over to Missy Deuce, who is going to talk about advances of credits under the relief provisions.
Thanks, Lynn. So now that Lynn and Sid have given an extensive overview of the relevant credit and deferral provisions in the FFCRA and the CARES Act, we wanted to just touch briefly on the processing side of the credits by the IRS. So as refundable credits against employment taxes, it makes sense that employers would report these credits on the employment tax return, in most cases the 941, and they will do this starting with the second quarter 941. But in order to accommodate the ability for employers to get in advance of the qualified leave credits and the employee retention credit, the IRS created in a very short period of time the Form 7200 advance payment of employer credits due to COVID-19 that I think both Sid and Lynn touched on briefly. The form asks for basic information, employer name, address, EIN, some historical filing data, and of course relevant information about the advanced credits that the employer is requesting. We wanted to note that if an employer uses a third-party payer, such as a CPEO, a 3504 agent, or a PEO that uses its own EIN on the aggregate 941, the employer must also indicate the name and EIN of the third-party payer on the Form 7200. Employers submit the 7200 by faxing it to the number on the face of the form. The 7200 instructions also make clear, consistent with Notice 2020-22, which Lynn mentioned, that before filing the Form 7200 to claim in advance, an employer should first reduce its employment tax deposit to account for the credit. If an employer requests an advance on the Form 7200, beginning with the second quarter 941, the employer will then reconcile any advance payments and reduced deposits on the employment tax return that it files. No employer is required to file the Form 7200. An employer can request the amount of the credit that exceeds its reduced deposits by filing the Form 7200 or by claiming the credits on its employment tax return, getting a refund for any excess subject to regular offset. As Form 7200s have started to be filed, the IRS wanted to highlight some common errors they're seeing in an effort to prevent such errors from reoccurring or continuing. They recently released an e-news for payroll professionals that discussed some of these errors, and I thought I'd just mention a few of those now. So some of the common errors that they're seeing include missing or inaccurate EINs, employers that are checking more than one box for the applicable calendar quarter that the form relates to, checking more than one box for Part 1, Line A, which asks what employment tax return the employer will file for 2020, not completing Part 2 of the form, which is the critical part of the form that asks relevant information regarding the advanced credits, and or filling that section of the form out, not using dollar amounts. Finally, they're seeing forms that aren't signed. So just highlighting those common errors that in the event taxpayers are considering filing as Form 7200, they should watch out for. I'll also mention briefly that the IRS today, in addition to the 7200 that was released in March, today the IRS released a draft of the revised Form 941 for use in the second, third, and fourth quarters of 2020. And this revised 941, draft 941, reflects new lines for employers to report the credits they've claimed on their 7200, as well as additional credits they're claiming for the quarter, and deposits that they've deferred pursuant to the CARES Act. Revised 941 instructions will be released shortly. The IRS draft form is available at irs.gov/draftforms. We can also provide comments on the form, and the information for where to provide comments is available on the draft form. There will also be a revised Schedule R, and third-party payers who have clients that take the credit will need to file a Schedule R reporting those credits. This applies to CPEOs, 3504 agents, and other third-party payers such as PEOs, although third-party payers that don't otherwise have a Schedule R filing obligation only need to include information on the Schedule R regarding clients that claim the credit. And I think that's actually it from the processing side, especially since I know we're running a little long, so I'll stop there and turn it back, I guess, to Ed.
Sorry, Missy, I have just a really quick question. Is that okay? This is Chaya. How many are you? Sorry, I think I was muted by accident. How many are you guys expecting to receive of these, or is there even a thought about how many 7200s you're going to expect to receive?
I'm not sure that we know the answer to that or can really answer that question. I mean, I think it was, as I mentioned earlier, obviously employers can request an advance of the credit, but they don't have to. There's no obligation to file the 7200. They can account account for the
They can do it on the 941.
They can do it on the 941. They can do some on the 7200 and then reconcile on the 941. So
have there been any thoughts as of yet? Because I know everything's moving so quickly. Have there been any thoughts as of yet, as in terms of policing all of this and basically getting that ready, or is it just too soon for you to go there yet?
I'm not sure I know what you mean. I mean, the forms released.
This is Janine. I can jump in to say that, as I mentioned at the very beginning, as our whole coordination process includes, interpreting the law, working with Treasury to, policy calls and interpretation and all of that. But the other piece of it is working with the IRS to create the process, which includes creating the forms and creating all the systemic and system changes needed for things. And so certainly, as you can imagine, there is thought to make sure to have appropriate compliance. We can't say anything more than that, but certainly that is an aspect anytime you're preparing form changes or new processes.
Ed, I think you had a question.
No, I'm good. I think does anyone else have any questions from our panelists? If not, we'll move over to questions from our live audience. Thank you very much, panelists, for that superb, detailed presentation. As I said, we're now ready to take questions from our live audience. We do have many already. Please use the question and answer feature on your webinar interface. And so without further ado, I'm going to ask our panelists some of the questions that we've seen already, one of which was a request if we can discuss briefly Section 7005 of the Family First Act, confirming that employers don't need to withhold the 6.2% Social Security, the OASDI employer excise tax on amounts required to be paid to employees under the EPSL and the EPFL portion of the Act.
That's correct. Under Section 7005A, there is no requirement to it. The wages that are required to be paid under Division C and E are not subject to the employer's share of Social Security taxes.
We have another question: are you limited to wages for the payroll period when you reduce I'll say this again. Are you limited to wages for the payroll period when you reduce deposits for that payroll period?
This is Janine. If I understand the question, I think the answer is no. If you walk through the notice, the issue is at any point in time, are your deposits sufficient under the normal 6302 rules? Are your deposits sufficient to meet your liability as you're going through the quarter? But of course, now you're taking into account the ability to defer under Section 2302 of the CARES Act, and you're taking into account your ability to anticipate your credits for the wages you paid under Notice 2020-22 and reduce the deposit. So as you're moving through the quarter, obviously, as all employers always do, they keep track of their deposits compared to their liability. And now, of course, you will think about your deposits compared to your liability, taking into account those two new, the one provision in the CARES Act and then the notice that allows you to reduce your deposit. So it's a, if you will, a cumulative process, and that's where the 941 that was just released this morning, or I guess it was this morning, you'll see, and people probably have not even had a chance to really look at that in draft yet, but you'll see that there are various lines, not only for the credits, but also for the deferral. And we appreciate that employers and third parties who are going to be filing this 941 in the second quarter want to understand how those lines work, how the deposits work. And that's where, as Missy said, draft instructions will be released in the near future. Can't obviously give any kind of timeline for that, but we'll try and further explain how an employer will report on their second quarter 941.
Okay. Questions about the essential nature if, and this is for, I would imagine, employers who operate in multiple jurisdictions, and that is, if an employer is deemed essential in one jurisdiction, but is not essential in another jurisdiction, what impact, if any, does that have on their status as a quote-unquote eligible employer?
And this is said, we actually do address that in the FAQs, and if an employer is essential in one place but they're not essential in the other, under the aggregation rules, they can be entitled to the credit.
All right.
But we cover it specifically in the new set of FAQs. So to the extent that you have any questions on that, I encourage you to look at the scenarios that we set forth there.
Question about self-employed individuals. Will deferral for a self-employed individual be taken on Form SC at the year end, or is there anything else that needs to be done other than simply reducing the estimated tax payments that the self-employed individual makes during the course of the year?
We are still determining those issues as well. I would defer to my other panelists if they have any more insight in that, but the bottom line is we are still working through exactly how that provision is going to work and how people are going to report those.
Here's a question that would seem to be from folks who deal with clients who have trust fund recovery issues, and that's what happens if an employer defers their payment of payroll taxes pursuant to the deferral provisions, but ends up going out of business before they can repay. Will the owners of that business, the responsible persons, be personally liable for those unpaid taxes? For the unpaid portion, presumably the portion that was deferred.
Well, I believe the trust fund recovery penalty only applies to the portion that's withheld from employees, not the employer share that can be deferred.
How about the employer share for the company itself? Would there be a look-through or a piercing of the corporate shield in that instance, or is that a corporate?
I don't think we've considered that. I don't have an answer for that one.
Here's a question.
It also seems like it might be hard, Ed, to argue that it was willful, but in the sense of, you go out of business.
Something that could well happen under our current environment. Here's a question about the federal and state unemployment taxes, FUTA. Are the payments made under the Family First Act, presumably the emergency family paid leave and emergency family sick leave, are those payments subject to FUTA, the federal and state unemployment tax? You guys can answer for the federal, of course.
There's no exclusion from FUTA for these, so.
Right then. We have a question about input from the legislature. A writer tells us that he spoke, or this person spoke to the staff of the tax writing committees that drafted the employee retention credit, and the indication that they had was that the legislative intent was that the employer portion of the health care costs would qualify for the retention credit, even if the wages were not paid. Any comments on that, or any alternative view?
No comments from counsel other than to say what our, we refer to our FAQs for our position of interpreting the law. Obviously, if any of the other panelists want to talk about any of that, they're certainly welcome to.
Any of our non-governmental panelists care to provide a comment on that?
Only to emphasize what has been said already, that there seems to be a difference of view between at least some of the staff up on the Hill and how the provision is being interpreted by IRS. One broad question that hasn't been broached is what that means in terms of reasonable reliance on the FAQs. The FAQs state at the beginning that they are not a binding position for the IRS or taxpayers, can't be relied on in court. The Blue Book itself, as well, is not typically viewed as binding legislative history. I don't know whether any of the IRS or private sector panelists care to comment on what will be considered reasonable position, on what basis you might construct a reasonable position when there are differences like this.
This is Janine from Counsel. I would say we don't really have any specific comment to make on that, other than obviously the FAQs are sometimes used to provide helpful information as soon as we can. We appreciate the guidance process is something different, and obviously this is something just across Counsel and Treasury for how we are trying to implement things quickly, with still realizing that there could be places where there are differing opinions, and we'll see how we're able to move forward. And you can just continue to watch Counsel, Chief-O's, any broader statements from Chief Counsel or Treasury regarding future plans that might happen beyond FAQs.
Yeah, I think you're going to have to just stay fluid with it also, with what they're saying. I think you're just going to have to stay fluid in terms of what's going to be considered reasonable cause. Sorry, Ed.
All right, then. Now, the question that was posed as regard to the FAQs, are there plans to reduce those or some portion of those to regulation?
This is Janine from Counsel. We're not prepared to answer that at this time.
Okay. Right then. As regard to the FAQs, a questioner wants to know that their interpretation of the FAQs are that if you pay qualified wages in the first quarter for purposes of the employee retention credit, do you report them on the second quarter, 941? That seems to be the interpretation that this writer pulled from the FAQs. Is that in fact correct? And can you provide some clarification on that?
Yes, this is Missy. That's right. You can see on the draft 941 that was just released that there are lines on the form for reporting employee retention credits that were paid in the first quarter.
Right. Here's a question about paid time off. If an employer advances paid time off or sick wages, that is that for paid time off or sick wages that were not earned by virtue of the duration the employee worked, but and pays that amount to an employee when the employee is not working, can the advance of that paid time off or sick pay count as qualified wages? And I guess to add further clarity, if the employer has more than 100 employees, does that make a difference?
I'm not sure that we understood the question, so or if it was too hypothetical. So maybe if one of the Kurt or anyone else wants to offer a thought.
I think this is Kurt. This is Kurt. I think that the gist of the question and others like it is, what if you are providing something that maybe is labeled PTO or vacation, but lacks some of the typical attributes of that? Say it is being provided before it's earned under your leave program, or I think one of the questioners asked, and I've certainly seen the question, if an employee is required to take the leave, even if he or she didn't want to. Is that, I've also seen the question, what happens if, for internal accounting purposes, you're simply charging the leave payments, the payments to people who are not performing services to a vacation fund? Is there flexibility in the interpretation in the FAQs about when leave and PTO is not going to be counted sort of along those lines in situations where it lacks some of the attributes of typical leave.
Thank you. I would refer people to question 56 of those FAQs. That's right now what is our position on PTO. And and I will just refer to as far as the specific situation, we're not really in a position to answer that specific hypothetical at this time. But what our FAQ says is that if the employer, if it's 100 or more employer, it's not the employer can't treat as qualified wages the amount for paid time off. Those wages are paid pursuant to an existing leave policies. They represent benefits accrued during a prior period. So that's kind of a dividing line that we set up in the FAQs, and with respect to how that would play out in with something outside that hypo. Thank you for raising it. We'd have to consider that and continue deliberating on that.
Well, I think we have time for one or two more questions, and here's one that was specifically from the FAQs, and this writer wants to confirm that as regard to FAQs 36 and 37, they want to confirm that if those FAQs mean that if one company in an aggregated group has a partial suspension of operations, for example, a store shuts down due to government order, that this triggers the eligible employer status for all of the entities in the group, so that the amounts paid to employees for not working in a different business unit of a different company in the group are in fact creditable. So we've got, and this would be drawn, as I say, specifically from FAQs 36 and 37.
And I would refer back to FAQ 26, actually, and the answer is that we go to the aggregation rules. And those the answer is yes. If they are aggregated, then that status applies to all. Those aggregation rules under 52A and 52B, they apply for the purposes of determining whether the employer has a trade or business operation that was fully or partially suspended due to orders related to COVID-19 from an appropriate government authority. So question 26 does lay out the impact of those aggregation rules and all these rules for purposes of the employee retention credit.
And one final question, and this has to do with payments. And the question is, how can taxpayers designate payments to trust fund liabilities in this COVID-19 environment? In other words, is there an office accepting designated checks or an online method to designate payments to trust fund liabilities per quarter? How can we get this done is the question.
This is Janine. I don't think we're in a position of answering that question at this time. I think, again, we're as you'll see the draft instructions to the 941 when they're released will explain how the deferral piece, which is for the non-trust fund portion, will be reflected on the second quarter 941. Additional guidance will be coming. I use the term guidance loosely there. The additional FAQs should be coming about the deferral provision, as Lynn said earlier. And so there too, we'll try and provide additional information that will be helpful to taxpayers and tax practitioners. How it interrelates with the normal or pre-existing rules for designation of deposits toward different liabilities, I think is something that we've not yet considered or addressed. So again, with all of these questions that have been posed that we haven't been able to answer just through clarification today, we welcome receiving them. Again, people are welcome to email, to call in. Obviously, we're hearing the questions today. People are welcome to write in letters. Again, we are fielding them and taking them into account to think about additional things that we might be able to answer in a way that's helpful without, again, trying to address every possible fact pattern. So unfortunately, we're ending on one that we can't answer, but again, we appreciate hearing the question, and that is kind of the situation that we all find ourselves in, is as we come up with new questions and new developments, we will consider them and do what we can to provide additional information.
All right then, and Janine's word will be the final one for today. That's all we have, but before we leave, I'm going to ask that all the attendees who desire CLA credit, please stay connected for instructions for your CLA certificate. And there's also going to be an evaluation that will pop up on your screen, and we would be very grateful if you would take the time to complete that. So, to our faculty from today's program, Sydney Gernstein, Kurt Lawson, Lynne Camillo, Will Weissman, Chaya Kundra, Melissa Deuce Missy, and last and certainly not least, Janine Cook, thank you so much for sharing your expertise with us. On behalf of the American Bar Association, I'm Ed Leyden, thanking you for all of you for joining us. Please stay safe. I will now turn you over to our operator for additional useful information. Thank you very much. Goodbye.
Thank you. On behalf of the American Bar Association and the ABA Taxation Section, thank you for participating in this program. To learn more about the sponsors, visit the ABA website, www.americanbar.org. Thank you, and please click on the evaluation link. We value your feedback.